All right, let's dive in. Today we're going deep on safety and soundness in lending.
Should be interesting.
Yeah, super important stuff, right? You sent over some excerpts from, what was it, a study guide
Yeah.
on like federal banking regulations and all that,
Yeah, it's good.
loan portfolio management, the whole shebang.
Yeah.
So I guess what we're trying to do today is kind of pull out like the most important elements, right? Like how do banks actually manage credit risk? What are the key things that make lending safe and keep the whole system stable?
Yeah, absolutely. It's all about the bedrock, right? The foundational rules that keep our financial institutions operating responsibly.
Okay, so where do we even begin with something like that?
Well, I think the best place to start is with Section 39 of the FDI Act.
All right, Section 39 FDI Act. What's the big deal with that?
So this section basically mandates that every single federal banking agency, every one of them, has to establish safety and soundness standards
Okay.
for all insured depository institutions, IDIs for short.
Yeah.
So it's like a universal requirement, right? Safety and soundness standards. It's the rules set by those federal banking agencies for all those IDIs.
Okay, so it's like this baseline layer of rules that everybody's got to follow.
Exactly.
And then I guess on top of that, we have operational and managerial safety and soundness standards.
Right.
So how do those fit in?
Yeah, so these standards get more into the nitty-gritty, right? They're spelled out in Appendix A of Part 365,
Mm-hmm.
and they zero in on how banks handle their loan portfolio.
Okay.
We're talking about the overall quality of those loans. We call that asset quality. How effective are their internal controls? How rigorous is their credit underwriting process?
Right.
And, is the loan documentation complete? All those kinds of details.
Makes sense.
So to put it simply, those operational and managerial safety and soundness standards, they cover the loan portfolio's quality, controls, underwriting, documentation, all the nuts and bolts of how banks actually put those broader safety and soundness goals into practice.
Right. So it's taking those big ideas and turning them into like actions, steps, procedures.
Exactly.
Okay, so once you have all those loans out there, right, you need a way to like keep an eye on them, make sure things are running smoothly. So that's where the loan review system comes in, right?
Absolutely. A loan review system, it's like a bank's checkup on its loans.
Mm-hmm.
It's a systematic process they use to assess the credit quality of their whole portfolio.
Okay.
So it's how they spot potential problem loans early on,
Yeah.
and they assign a risk rating to every single loan.
Okay.
So in essence, it assesses that credit quality, it finds those problem loans, and it assigns those risk ratings. It's like their early warning system for the loan portfolio.
Makes sense. So when they're assigning those risk ratings, they're not just like making them up.
Right, right. There's a system for that.
Exactly. They rely on something called a credit risk or grading system.
Okay.
So this is their internal framework, and it's used within that loan review process to categorize each loan.
Hmm.
How risky is this loan?
So this helps them prioritize their efforts. Which loans need more attention, more monitoring, and they get a better understanding of their overall risk profile.
Yeah.
So to simplify, a credit risk or grading system just categorizes the risk of those loans.
Okay, so once you have the risk levels figured out, then you
Yeah.
got to prepare for potential losses, right? That's where ACL or AACL comes in, I think.
You got it. ACL, the allowance for credit losses, or sometimes you'll see it as AACL, allowance for available credit losses.
Hmm.
This is basically the bank's best guess at how much they might lose
Right.
from their entire loan portfolio.
Okay.
All that information they gathered during loan review. Super important for determining if this allowance, is it enough? Are they setting aside enough?
Gotcha.
And of course, there are regulatory guidelines that tell banks how to review and maintain their ACL.
Right. Always going to have guidelines, right?
Of course.
So to sum it up, ACL, AACL, it's an estimate of potential loan losses,
Yeah,
their buffer against future defaults.
exactly. It's like a rainy day fund for bad loans.
Makes sense. All right, so we've got all these moving parts. We've got these standards, we've got reviews, we've got allowances. It seems like there needs to be like a central document, like a guiding principle for all of this.
Yeah.
Is that the loan policy?
The loan policy, you hit the nail on the head. Think of it as the bank's lending Bible.
Okay.
It's this comprehensive set of guidelines. It lays out their approach to everything related to lending.
Wow, everything.
Pretty much. It's a wide range of stuff. How they decide on that allowance for credit losses we just talked about,
Hmm.
how they keep those credit files organized, how they handle collections, who has the authority to approve loans,
Sure.
what are the responsibilities of the board in all this,
Makes sense.
guidelines for unsecured loans, interest rates, repayment terms,
Yeah.
loan-to-value guidelines, LTV,
Hmm.
limits on how much they can lend compared to their assets, managing overdrafts, defining their trade area, where do they typically lend? Risk diversification, making sure they're not putting all their eggs in one basket. How they conduct those loan reviews and their overall lending philosophy.
Wow, that's a lot to cram into one policy.
It is, but it's essential. So to summarize, that loan policy, it outlines the bank's entire approach to lending.
Their lending Bible.
Exactly.
Okay, so let's dig a little deeper into some of these specific things that you mentioned.
Sure.
You talked about lending authority. What does that really mean?
Yeah, so lending authority gets into who has the power to make decisions about loans.
Oh.
So it sets limits for individuals like loan officers, committees within the bank, the board of directors, who can approve or renew a loan. Who sets those interest rate and repayment terms, especially for loans without collateral.
Okay.
So essentially, lending authority defines who can approve loans and set the terms.
Gotcha. So it's like it prevents one person from, going rogue and making risky loans.
Exactly. It's a system of checks and balances.
Right. Spread the responsibility.
Exactly.
Okay. And then you mentioned LTV guidelines. I know that stands for loan to value, but what does that mean in practical terms?
So LTV guidelines, they're all about how much money a bank is willing to lend
Mm-hmm.
compared to the value of the asset that's backing that loan.
Okay. So the collateral.
Exactly.
Yeah.
So they set limits on that ratio,
Makes sense.
and they also dictate what kind of documentation you need for different types of loans.
Okay.
So to sum up, LTV guidelines limit loan amounts based on that collateral value, a key tool for managing risk, especially with secured lending.
Right. Because if the collateral isn't worth enough, then the loan becomes riskier.
Exactly.
Okay. And you mentioned something about a bank's trade area. What is that exactly? Like, is that just where they prefer to do business?
Yeah, pretty much. A trade area is just a way of describing that typical geographic area where a bank focuses its lending activity.
Okay.
The loan policy will usually say, here's our main area, and here are the circumstances where we might consider going outside of it. So to reiterate, a trade area is a bank's typical lending geography. It helps them understand the local market, the local economy, all of that.
Yeah, makes sense. So banks can't just lend to anyone and everyone, right? They've got to think about the overall mix of their loans. So that brings us to risk diversification and concentrations. Can you explain those a little?
Of course. So risk diversification is all about balance, right?
Mhm.
Banks want a good mix of different types of loans
Mhm.
spread across different industries, different borrowers. They don't want to
Yeah.
be too exposed to any one thing.
Right.
And then loan concentrations, those are situations where they have a really significant amount of loans that are economically related.
Gotcha.
So the loan policy outlines how the bank monitors those concentrations, how they plan to act if they get too big, that kind of thing.
Right. Makes sense. So to sum it up,
Yeah.
risk diversification, managing the mix of loans, concentrations, those are those large volumes of related loans. Got to avoid too much concentration, right?
Absolutely. It's all about spreading the risk.
Now, we talked about loan review earlier, but I think it would be helpful to formally define it as a function within a bank.
Definitely. So loan review, as a function, it encompasses all those specific duties assigned to different parts of the bank.
Okay.
You've got your credit underwriting department, loan administration, the teams that handle those problem loans, all of that.
Mm-hmm.
So their responsibilities, they include assigning those initial credit grades to loans, making sure those grades are updated as things change,
Okay.
gathering information to assess the bank's allowance for credit losses.
Right.
And while those loan officers are the first line of defense,
Yeah.
right? They're the ones seeing those potential problems early on. Their assessment should be subject to independent review.
Makes sense.
So in short, loan review involves all these different areas, all working together to keep an eye on loan quality.
Right. So it's like this built-in check on the whole lending process.
Exactly.
So if we zoom in on the loan review system itself, what are the essential elements that it should have?
Yeah, a strong loan review system, it's got to have a few key components, right?
Right.
The qualifications of the people doing the reviews. Are they independent?
Mm-hmm.
How often do they do them? What's the scope? Which loans are they looking at?
Yeah.
How in-depth is their analysis? How do they review their findings and make sure actions are taken? and how do they document and share everything.
Gotcha.
So in summary, we're talking about things like personnel, frequency, scope, and follow-up, all crucial for an effective loan review system.
Makes sense. Now, how do banks actually decide which loans to review?
Right.
They can't look at every single one all the time.
No, they can't. It's
Yeah.
all about selecting a good sample. Right.
Okay, so loan review sample selection. How does that work?
Well, it needs to be strategic.
Yeah.
It should consider the bank's business model, its complexity, its risk profile, the kinds of loans they make.
Mm-hmm.
Now, the approach might be different for loans that aren't all the same, like commercial loans or agricultural loans, versus your more standardized consumer loans. And while there's no magic number, no set percentage of loans they have to review, it should be enough to make sure they're catching those major credit risks.
Right, so it's risk-based, essentially.
Exactly.
Okay, now let's talk about what happens when borrowers start falling behind on payments.
Sure.
What makes a loan past due?
Well, in general, a loan is considered past due when a payment, principal or interest, is unpaid for 30 days or more.
Okay.
Now, for loans with monthly payments, usually it's when they're behind by 2 or more payments.
Mm-hmm.
For open-end credit, like credit cards, it's when they miss the minimum payment for 2 billing cycles in a row.
Okay.
So a past due loan, it's essentially one with payments unpaid for a certain amount of time. And these are the loans that start getting extra attention.
Right, because they're signaling a potential problem.
Exactly.
Okay, now sometimes borrowers hit a rough patch, right? It's just temporary.
Yeah.
So what options do banks have to help them get back on track? Something like re-aging a loan.
Yeah, so re-aging is a tool banks can use, but it's not a free pass, right?
Mm.
It's for those short-term difficulties. The borrower has to show they're willing and able to start making payments again.
Makes sense.
And there are limits on how often you can re-age a loan. For open-end credit, it's once every 12 months or twice in 5 years.
Okay.
For closed-end loans, well, policies should limit how much you extend those terms.
Mm-hmm.
And you generally can't lend more money to cover unpaid interest or fees.
Right. Gotta have some rules.
Of course. So re-aging, it can adjust the loan status for those temporary hardships, but there are limitations. It's all about trying to avoid unnecessary defaults when the situation is truly short-term.
Right, giving them a chance to catch up.
Exactly.
So what happens when a borrower makes a partial payment? How does that factor into whether a loan is considered delinquent?
Well, there are a couple of ways banks can handle that.
Okay.
One is called the 90% rule. If the payment is at least 90% of what's due,
Mm-hmm.
they can treat it like a full payment for delinquency purposes.
Okay.
The other way is the aggregate payment rule. So they add up all those partial payments. And if they eventually equal a full payment, well, it might not trigger a delinquency status.
Okay, so they have some options there.
Yeah, it gives them some flexibility in recognizing those borrower efforts.
Makes sense. All right, let's talk about some specific types of lending now.
Sure.
Accounts receivable financing. It sounds a little specialized.
It is. AR financing, it's for businesses that need to unlock cash tied up in those unpaid invoices, their receivables.
Okay, so they're using their receivables as collateral.
Exactly. So this type of financing, it's often attractive to businesses that are growing really fast. Or maybe they're short on working capital. Or maybe they used to be less risky, but now they are.
Gotcha.
Or maybe their business isn't seasonal, so they need financing year-round, that kind of thing.
Okay, so they're using those receivables to get access to cash now.
Yeah, it's a way to leverage those future sales.
Makes sense. So how does a bank actually go about providing the funds in AR financing?
Well, there are two main methods. One is called blanket assignment.
Hmm.
The borrower gives the bank a heads up, like every so often, about their total receivables,
Mm-hmm.
and the bank advances a percentage of that.
Okay.
Now, this can be done where the customer keeps paying the borrower directly,
Okay.
or the customers are told to pay the bank.
Gotcha.
The other method, it's ledgering the accounts.
Mm-hmm.
So the bank gets copies of invoices, shipping documents, all that,
Mm-hmm.
and then they advance a percentage based on that.
Okay.
And usually in that case, the customers pay the bank directly.
Gotcha. So they have different ways of managing the flow of money.
Exactly. Different levels of control for the lender.
Okay, now let's talk about leverage lending. I hear that term all the time, but I'm not always sure what it really means.
Yeah, it gets thrown around a lot. Basically, leveraged lending, it's when loans are used for very specific things, buyouts, acquisitions, big capital distributions.
Mm-hmm.
And the key here is the borrower has a lot of debt compared to their earnings or their equity. So you look at things like their debt to EBITDA ratio, their debt to net worth ratio.
Right.
If those are really high, well, That's a sign of a highly leveraged borrower.
Gotcha. So leverage lending is all about high debt levels for those specific types of transactions.
Exactly. High debt relative to their financial capacity. That's the key.
Okay, so when a company has a ton of debt, how do banks figure out how much they're really worth? Not just their stuff, but like their potential, their future earnings.
Right. That's where enterprise value comes in.
Okay.
It's trying to capture the whole economic value of a business,
Hmm.
not just their assets, but their intangible stuff too.
Hmm.
Brand reputation, customer relationships, that kind of thing.
Okay.
Banks look at this when they're deciding if a loan makes sense, if the borrower can reduce their debt, if they can access capital markets.
Makes sense.
How strong are those secondary repayment sources?
Right.
And it's super important that this valuation is done by someone qualified, independent.
Mhm.
But even then, enterprise value, it's not usually considered a primary source of repayment unless it's really solid.
Okay.
And any part of a loan that isn't covered by collateral or a strong enterprise value, well, that's probably going to be seen as higher risk.
Right.
And if the borrower doesn't have a clear path to reduce their debt, that's a red flag too.
Gotcha. So enterprise value, it's basically the intangible worth of a business as an ongoing concern.
Exactly. It gives a more complete picture of their financial health.
Okay, now how do you actually calculate enterprise value? What are the different methods?
Well, there are a few common approaches.
Okay.
First, there's the asset-based method, so you look at the net value of all their assets.
Okay.
Then there's the income-based method. This one focuses on the present value of their future cash flows or earnings.
Mm-hmm.
Within that, you've got capitalized cash flow, which is for businesses with stable, predictable cash flows,
Okay.
and then discounted cash flow, where you're forecasting those future cash flows and discounting them back to present value.
Right, because money today is worth more than money tomorrow.
Exactly.
Right.
And then there's the market-based method. This one uses data from similar companies, but it can be a little less precise.
Gotcha. So asset-based, income-based, market-based, different tools for different situations.
Exactly. Each has its own strengths and weaknesses.
Okay, so when banks are dealing with these leveraged loans, how do they go about, like, assessing and assigning a risk rating?
So usually the starting point is the borrower's own financial strength, just on their own. That's the primary basis.
Okay.
But sometimes there's a sponsor involved, like a private equity firm, right? And their financial support could be a factor.
Mm-hmm.
But only if there's a proven track record, if they have a good reason to keep supporting the borrower, if they have the money to do it, and if they've said they will.
Right, got to have all those pieces in place.
Exactly. And strong risk management is absolutely crucial here. If a bank's practices aren't robust enough, well, that can lead to problems during exams.
Right, regulators will come knocking.
Exactly. So to sum it up, leveraged loans, they're risk-rated based on that borrower's strength, but with potential consideration of the sponsor's involvement, if it makes sense.
So the sponsor can add a layer of security in a way.
Yeah, in the right circumstances.
Okay, now we've talked about high debt levels. What about deleveraging? How do banks know if a company is making progress in reducing their debt?
So deleveraging, it's all about getting that debt down to a more manageable level.
Okay.
So banks look at projections, but they have to be realistic. Can the borrower actually pay down that debt with their cash flow?
Right.
Regulators, they typically expect borrowers to repay at least half of their total debt within 5 to 7 years.
Yeah.
Using their operating cash flow, not by just refinancing.
Makes sense.
If refinancing is the only way they can see to deal with that debt, well, that's a sign of higher risk.
Right, because it's not really solving the problem, just kicking the can down the road.
Exactly. Deleveraging, it's about long-term viability, not short-term fixes.
All right, let's shift gears now and talk about a very specific area of lending. Oil and gas.
Okay.
This one always seems extra complicated.
It is. It is. Oil and gas lending, it's complex for a bunch of reasons. Global markets, politics, environmental rules, the price of oil and gas jumping up and down, you name it.
Right, it's a roller coaster.
Yeah, can be. Now, the industry itself is usually broken down into a few segments.
Okay.
Upstream, that's exploration and production.
Mm.
Midstream, transportation and processing.
Okay, yeah.
Downstream, refining and marketing.
Gotcha.
And then support and services.
Okay,
That covers a lot of different things.
makes sense.
And generally speaking, the highest credit risk tends to be in that upstream segment and support and services.
Okay, so those are the riskier parts of the oil and gas world.
Yeah, they tend to be.
Now, within oil and gas lending, I've heard the terms reserve-based lending and asset-based lending.
Right.
What's the key difference between those two?
So the big difference is in where that repayment comes from and the collateral. Reserve-based lending, RBL for short, relies on the cash flow from those oil and gas reserves.
Mm-hmm.
That's the main source of repayment.
Okay.
And the loans are secured by proven reserves.
Makes sense.
A third-party engineering report is super important here. They use that to establish the borrowing base.
Okay.
Now, asset-based lending, ABL, that relies on liquidating other assets.
Okay.
Things like accounts receivable, inventory, that kind of stuff.
Gotcha. So RBL is all about the reserves and the cash flow they generate. ABL is more about those other assets that could be sold off.
Exactly. They serve different needs and different types of borrowers within the oil and gas industry.
Now, when we talk about reserves, we hear these classifications, P1, P2, P3. What do those actually mean?
So those are all about how certain we are that the oil and gas is actually there and can be extracted economically.
Okay.
P1, those are the proved reserves. They have at least a 90% chance of being recovered.
Okay, so pretty high certainty.
Yeah, very high. And
Wow.
within P1, you've got different categories. PDP, those are reserves that are already developed and producing.
Makes sense.
PDNP, those are developed but not producing yet.
Okay.
And then PUD, proved undeveloped, meaning they haven't even started developing them yet.
Gotcha.
And those last two, they're going to require more investment, more capital expenditure.
Right, you got to spend money to make money, right?
Yeah, exactly. Now, P2, those are probable reserves. Less certain, but there's still a decent chance.
Okay.
And then P3, possible reserves, those are pretty speculative.
Gotcha. So the further down the alphabet you go, the riskier it gets?
Pretty much. Now, when it comes to lending, generally speaking, only those proved reserves, P1, those are the ones that are considered as collateral value in the borrowing base.
Okay.
Probable and possible reserves, they usually don't get assigned any value.
Makes sense. So proved reserves are the most reliable, probable and possible are more of a gamble.
Exactly.
Okay, so for reserve-based lending, these proved reserves are super important. How do banks get those reliable estimates of what's actually there?
They rely on reserve engineering reports.
Okay.
These are basically expert assessments of how much oil and gas can be recovered.
Mm-hmm.
They use geological data, engineering principles, reasonable assumptions about technology, and operating efficiency.
Okay.
These reports, they've got to be objective, well-documented, and prepared by engineers who are independent of the whole lending process.
Right. Got to avoid conflicts of interest.
Exactly. Banks should also check out those engineers' qualifications, make sure they're legit, and review their work from time to time.
So these reserve engineering reports, they're the foundation of the whole lending decision.
Yeah, they provide that essential technical groundwork.
Okay, so once the bank has those reserve estimates, how do they turn that into an actual loan amount?
That's where the borrowing base comes in.
Okay.
It's basically the collateral base for that RBL.
Mm-hmm.
It's mostly made up of the value of those PDP reserves, those proved developed producing reserves.
Okay.
Now, the PDNP and PUD reserves, those usually get adjusted downward to account for the additional risk.
Hmm.
Like a PDNP reserve might get reduced by 65-75%, and a PUD reserve by 25-50%, just as an example.
Okay.
And then they apply advance rates to that adjusted value.
Right.
And, of course, the borrowing base, it needs to be recalculated at least every 6 months with updated engineering reports.
So the borrowing base, it's essentially the amount the bank feels comfortable lending against those reserves?
Exactly. It's that portion of the reserves that they consider good collateral.
Okay, now banks also have to factor in those future oil and gas prices, right? That's where those price decks come into play.
Exactly. Price decks are the bank's educated guesses about what oil and gas prices are going to do in the future.
Okay, so they're forecasting.
Yeah, and they use those forecasts to figure out how much cash flow those reserves are going to generate.
Yeah.
And that helps determine the collateral value.
Right.
Now, a good bank, they're not just setting those price decks and forgetting about them.
Right, got to keep them updated.
They review and update them all the time based on what's happening in the market.
Makes sense.
And they often have different scenarios, a base case and then what-if scenarios.
Right, because who knows what's going to happen with oil and gas prices.
Exactly. It's a volatile market.
Okay, so they're factoring in time, they're factoring in future prices. What about the time value of money? What's that discount rate all about?
The discount rate, that's how they take those future cash flows and figure out what they're worth today.
Mm.
You know, $1 today is worth more than $1 tomorrow.
Exactly. Now, the SEC, they require public companies to use a 10% discount rate.
Okay.
But most banks, when they're making loans, they use something closer to 9%.
Okay.
And if the borrower's riskier, well, that rate might be higher.
Gotcha. So the discount rate, it's all about accounting for that risk and the time it takes to actually get those cash flows.
Exactly. It's a key part of the valuation.
Okay, so the bank's got to make sure the loan gets repaid as those reserves are produced, right? What are those reserve tail tests all about? So reserve tail tests, they're a way of checking that the loan repayment schedule lines up with how long those reserves are expected to last.
Okay.
They want to make sure the loan doesn't outlive the collateral, essentially.
Makes sense. So they're making sure the money comes in before the well runs dry, so to speak.
Exactly. They don't want to be left holding the bag when the reserves are depleted.
Okay. And given how much oil and gas prices can swing, hedging must be a pretty big deal in this type of lending.
It is. Hedging, it's a way for oil and gas producers to protect themselves from those price swings. They use things like futures contracts, swaps, those kinds of tools.
Okay.
And from a lender's perspective, it can actually reduce their risk because those hedged cash flows are more predictable.
Right. So it's less of a gamble for the bank.
Exactly. But banks will usually set limits on how much a borrower can hedge.
Okay.
Maybe 85% of their projected production, something like that.
Gotcha. So they're encouraging them to hedge some of the risk, but not all of it.
Exactly. Got to
Uh,
leave some skin in the game.
Makes sense. All right, let's move on to a different kind of lending now. Real estate loans.
Okay.
Super broad category.
Huge category, yeah.
What are the big risks that lenders are looking at here?
Well, with real estate, the big three are loan-to-value ratio, interest rate, and most importantly, the borrower's ability to repay.
Okay, so that repayment capacity is paramount.
Absolutely. They can't just rely on the appraised value of the property
Right.
because what it actually sells for, that could be different.
Yeah, appraisals aren't always perfect.
Definitely not.
Hmm.
So with real estate, it's all about those LTVs, the rates, and whether the borrower can actually make those payments.
Gotcha. So even though it's secured by real estate, the borrower's financial strength is still the most important thing.
Absolutely. It's the foundation of any sound loan.
Now, are there specific regulations that apply to real estate lending?
Oh, yeah, there are. Section 18 of the FDI Act, that's the big one. It mandates uniform regulations for all real estate loans. And then Part 365 goes even further. Banks have to have written policies, and those policies have to follow sound principles. Things like diversification, prudent underwriting, those LTV limits, how they administer those loans, monitoring the market.
Right, so it's like a whole framework for responsible real estate lending.
Exactly. They can't just wing it.
Now, within real estate lending, we've got construction lending. That's a whole other ballgame, right?
It is. It is. Lots of moving parts.
So what are the basic types of construction loans?
Well, you've got your residential construction loans. Those are for building homes. Commercial construction loans for building, commercial properties.
Okay.
And then you've got more general real estate construction loans.